Esteemed investors, distinguished delegates, and industry professionals, the global economic and financial ecosystem navigated a notably dynamic and layered environment this week, characterized by pivotal central bank policy enactments, unexpected signals of geopolitical de-escalation, and unprecedented multi-trillion-dollar valuation milestones in the technology sector. We shall proceed with an in-depth analysis of the financial topography of the current week, a period marked by a moderation in anti-inflationary rhetoric, yet punctuated by the progression of commercial rivalries between dominant economic powers into a new phase. Part 1. Monetary Policy and Central Bank Directives. The Federal Reserve's Dichotomy. The foremost item on this week's global economic agenda was unequivocally the United States Federal Reserve, Fed. In the context of its protracted tightening cycle, the Fed's decision to maintain the target range for the federal funds rate was consistent with broad market consensus. Nevertheless, two consequential elements, which might otherwise have been overshadowed by the rate decision, commanded critical market attention. First, the subtle shifts in the Fed's forward guidance and communication. And second, an unanticipated measure concerning its financial engineering toolkit. While the Fed acknowledged achieving incremental progress toward its mandated inflation target, it emphasized the persistence of downside risks. Chairman Jerome Powell's general demeanor during the subsequent press conference maintained a hawkish disposition, employing measured language to temper expectations of a premature rate reduction. Powell sought to counterbalance market optimism regarding decelerating inflation by reiterating the foundational principle of data dependence. This action served to reaffirm the institution's core policy stance that interest rates are anticipated to remain higher for longer. However, the principal catalyst for the market's immediate reaction was the indication that the Fed is contemplating the cessation of its quantitative tightening (QT) program, which governs the reduction of its balance sheet size. QT has been a crucial mechanism for withdrawing systemic liquidity and exerting upward pressure on longer-term yields. The prospect of pausing this initiative was interpreted as a signal of potential liquidity easement across the global financial system. Rationales for this decision include persistent fragilities within the regional banking sector and a proactive effort to sustain demand for U.S. Treasury securities. This dual policy signaling is construed as an attempt to simultaneously prosecute the inflation mandate via interest rates, while diligently safeguarding the stability of the financial architecture, the Eurozone, and the global inflationary trajectory. In the European theater, the release of Eurozone inflation data constituted a notable highlight this week. The annual Consumer Price Index, CPI, was observed to be converging towards the European Central Bank's ECB target parameters. Specifically, the decline in energy prices and the observed sequential deceleration in core inflation have alleviated pressure on the ECB. This scenario bolsters the probability of the ECB initiating a pause in further rate hikes in forthcoming policy sessions, thereby enhancing confidence in a potential soft landing trajectory for the Eurozone economy. This policy divergence among major global central banks implies a continuation of volatility in capital flows and foreign exchange markets. While the Fed's decisions regarding interest rates and balance sheet management remain the primary determinants of global liquidity conditions, we appear to be entering a phase where other significant central banks are increasingly prioritizing their idiosyncratic domestic inflation dynamics. Part 2. Geopolitics and Commercial Relations. U.S.-China Dialogue and Energy Security. The U.S.-China relationship, representing the two paramount global economies, constituted another focal point for financial markets. High-level discussions and diplomatic engagements throughout the week provided an unexpected indication of de-escalation in the protracted technological and commercial disputes. Reports suggesting that the Chinese government may suspend export restrictions on rare earth elements, materials indispensable for critical industries, or potentially conclude ongoing chip-related investigations targeting technology enterprises were broadly perceived as a salutary development for global supply chain efficacy. These indications fostered expectations that bottlenecks, particularly in advanced technology and semiconductor manufacturing, might abate. While this rapprochement may not represent a permanent resolution, it is indicative of a pragmatic effort by both Washington and Beijing to establish common ground to mitigate mutual economic detriment. Geopolitical exogenous shocks in energy markets. The direct impact of geopolitical tensions on energy markets was similarly pronounced this week. Events in the Black Sea region have re-elevated concerns regarding the security of global natural gas and crude oil supply. Specifically, the targeting of critical oil terminal infrastructure at a Russian port momentarily introduced the risk of supply disruption. Although oil prices experienced immediate upward volatility following this incident, a sustained price rally did not materialize due to underlying ambiguities in the aggregated demand forecast. Furthermore, shifts in international sanction regimes and commercial flows were closely monitored. The move by Turkish refineries to augment crude oil procurement from non-Russian sources following the imposition of new sanctions underscores the ongoing restructuring of global energy trade and the imperative for finding alternative routes to preserve supply chain resilience. Geopolitics is demonstrably a vector for fundamental change, influencing not merely pricing, but also commercial pathways and national energy policies in this contemporary environment. Part 3. Technology and Market Trends. The AI Economy and Valuation Extrapolation. The technology sector, which persists as a primary engine for risk appetite in global finance, reached headline status this week with a continuation of record-setting valuations. The artificial intelligence paradigm shift is actively transforming both capital markets and conventional business frameworks. The week's most consequential financial news revolved around the alleged preparations by OpenAI, a frontrunner in the generative AI domain, for a prodigious $1 trillion. Initial public offering IPO. This figure powerfully illustrates the firm's anticipated potential and the profound conviction of investors in AI technologies. A $1 trillion valuation would position OpenAI among the world's most valuable corporations, marking it as one of the most rapidly ascending entities in technological history. This development confirms that investment in artificial intelligence represents not a transient enthusiasm, but the inception of a multi-decade economic paradigm shift. In the semiconductor industry, the foundational bedrock of AI infrastructure, another benchmark was established. NVIDIA's market capitalization transcending the $5 trillion threshold serves as a concrete manifestation of the technological megatrend. This extraordinary valuation indicates NVIDIA's transformation beyond a mere chip producer into the principal enabler of the global AI architecture. Investors are basing their capital allocation decisions on the premise that the demand for the hardware that powers AI applications will geometrically increase in the ensuing years. However, these accelerated valuation trajectories inevitably engender discussions within the marketplace concerning long-term sustainability and the risk of asset bubbles. The earnings expectations for these corporations are predicated on significant future growth assumptions. And in an environment where global interest rates are projected to remain elevated, the valuation multiples of such high-growth equities are subject to continual scrutiny. Market experts contend that for the AI-driven ascent to be sustained, these companies must successfully translate projected revenues into quantifiable profitability. Part 4. Commodities and Global Credit Markets. An assessment of safe havens. Commodity markets this week were engaged in an effort to reconcile the implications of the Fed's policy decisions with evolving geopolitical circumstances. Precious metals. Gold, the established safe haven asset, commenced the week with support derived from the Fed's signal to potentially pause balance sheet reduction, yet it failed to sustain this momentum. The spot price of gold recorded a notable weekly decline. The principal factors contributing to this decline included a rise in global risk appetite stemming from the easing of U.S.-China commercial friction, and the expectation that Chairman Powell's hawkish tenor would defer potential rate cuts. As geopolitical risk perception relatively receded, demand for the ultimate safe haven diminished, and high real interest rates reduced the opportunity cost of holding non-yielding gold. Conversely, silver, and palladium, which possess significant industrial applications, concluded the week with gains, underpinned by the maintenance of global growth expectations and anticipated strength in manufacturing demand. This suggests that market focus is predominantly directed toward the risk of persistent inflation rather than the immediate threat of a severe economic contraction. Credit markets and risk advisory. A significant advisory also emanated from credit rating agencies, the arbiters of global financial system health. Moody's announced that the positive momentum for sovereign and corporate credit ratings has attained a plateau. This declaration signifies that in an era characterized by decelerating global economic expansion and increasing borrowing costs for both corporate entities and sovereign governments, the frequency and magnitude of future rating upgrades are projected to diminish. Moody's warning serves as a cautionary notice to investors, urging greater selectivity, particularly within highly leveraged market segments and the sovereign debt instruments of emerging economies. Given that global debt levels are at historical peaks, the probability of sustained high interest rates is reinstalling credit risk to the forefront of the financial agenda. Part 5. Synthesis and forward-looking assessment. The totality of the developments witnessed this week unequivocally indicates that the global economy is currently oscillating around three core equilibria: the management of inflation, the Fed, the mitigation of geopolitical risk, US-China, and the vector of technological transformation, artificial intelligence. Central banks, even as they provide indications of nearing the culmination of their anti-inflationary campaigns, are concurrently confronting the exigent necessity of preserving financial stability. The Fed's nuanced decision to maintain rates while signaling a potential balance sheet pause exemplifies this delicate policy tightrope walk. Furthermore, the extreme valuations within the technology sector underscore the market's willingness to discount substantial future growth potential into current asset prices. Yet, this also highlights the elevated risk appetite of capital flows seeking disproportionately high returns. In the ensuing period, the market's focus will be directed toward ascertaining the durability of the global growth momentum via incoming economic data. Key forthcoming global releases include consumer confidence indices for major economies, purchasing managers' indices PMI for the manufacturing and services sectors, and detailed labor market reports originating from both the United States and the Eurozone. As the global financial architecture endeavors to adapt to this contemporary epoch defined by elevated interest rates, intricate geopolitical relationships, and disruptive technological advancements, the paramount responsibility of the investment community is the accurate assessment of risk and preparedness for sustained volatility.